Batestelli.
We sure do.
And reports over to Fred Holland with our team in Lebanon. And then we have with us today to speak to you a little bit about the Washington Crossing portfolio, as well as give some market perspective going into 2013. It's Kevin Drawn with Washington Crossing Advisors. Good morning.
Good morning. Thank you.
So we'll get started here. The first thing I'm going to do is steal just a little bit of Mike's thunder. He gives you the current numbers on your portfolio, but I think I let a couple of you know a week and a half or 2 weeks ago that we finally we hit the $100 million mark that Llewellyn has been so eagerly awaiting to hit. And as of yesterday, it was just under 101.
Now remember, we did help to get there.
Absolutely. Absolutely.
I'd like to take the credit for that, but I can't. You guys did all the work.
The ending balance was $100,883,472. Appreciation in the account was about $4.7 million from the beginning of the year. So we have an estimated market return of about 4.91%. Roughly the first 6 weeks or so of the year. That compares to, again, we see a lot the Dow Jones and the S&P. The Dow Jones, which is an all-stock index of 7.11, and the S&P was up that same time period 7.34. Comparable blended index was up 4.06%. So we are off to a good start. Just kind of what we did last year. We just don't know what's out ahead of us and so on. But allocation-wise, we've got about 3% in cash. The bond allocation is at roughly 31%, and stocks we have about 66% in stocks or equities, of which 7.5% is the REIT portfolio, and all those fit within your guidelines of your investment policy.
When we look at the environment, things seem to be improving. When we look around and look at capital markets, we see that credit spreads have tightened in the credit markets. We see the stock markets have been performing better. When we look at the real economy, we see things are improving as well. Automobile sales, for example, are back up to about 15.5 million units. They had been as low as 9 million, 10 million units during the recession. We see that private jobs are once again being created, and it's being created on a consistent but very slow basis. So as we came into the year, most of the indicators that we looked at show that we were looking at an economy that was improving. It was nice to go through the year-end process and get into the new year without significant dislocation relative to the financial markets and the fiscal cliff. We all remember those debates going into New Year's. Thankfully, those passed without too much incident. But of course, as we go into the next couple months, we're going to be hearing more about that. We're going to be hearing about the sequester. We're going to be looking at some tough budget choices that need to be made in terms of taxation and spending. That has the potential to provide a little bit of choppiness in the months ahead. In addition, we still have risks out there in the form of Europe. Europe has not been settled by any means, but as we stand here today, we see that things are still moving forward. There are always risks in the equation, and the question comes from our point of view as equity investors. Well, how do we deal with these risks? And what I'm proud to say is that when we look back over our 10-year history managing equity portfolios, what we've seen is that we've gotten a very good rate of return while still managing the risk in the portfolio. In fact, according to Prima, who analyzes value managers, over the last 10 years, when you look at the risk compared to return for our investment strategy, we've ranked in the top 2%. So we're very proud of that. And I'd like